Good morning, everybody. Thank you for the opportunity to talk to you today about what I think is one of the most interesting areas that's emerging and developing in digital assets today, and that's derivatives. I'll do a brief introduction on myself and then hand it on down the line for folks to give you a little bit on their background. But Patrick Corker, I'm currently the head of strategy at Lukka. Lukka is a software and data company in the digital asset space. Before that, I was 6 years at Circle, where I was one of the founding team members for USDC, leading operations, finance, and risk, and then spent most of my younger years at Goldman, where I was the CFO of equity derivatives. So a little bit of background in this area myself, and with that, I'll hand it over to Rob.
Morning, everyone. My name is Rob Strebel. I'm head of relationship management at DRW and at Cumberland. DRW is a diversified trading firm based out of Chicago, been around since the early 90s. Cumberland is DRW's crypto trading firm. We were founded back in 2013, so we're considered an OG in the crypto space. We have since then grown into one of the largest liquidity providers for spot and options in the crypto space. I joined DRW back in May of 21. Before that, I was at UBS for 24 years on the rates derivatives desk.
Awesome, thanks. Chris?
Hi, I'm Chris Perkins. I'm president of Coin Fund. Coin Fund, we're investors. We're in our 10th year. We have 4 strategies. We have a seed strategy, a venture strategy, which is Series A and B. We have a liquid strategy. And then we're also the inventors of Caesar, which is the first staking rate index of its kind. My career, I started as a U.S. Marine, and then I did 15 years in traditional finance at Lehman Brothers and then Citigroup, largely in the derivative space.
Thank you for your service, Chris.
Semper Fi.
Yeah. Thank you.
Also, Chris Sullivan. I'm co-founder and PM for Hyperion Decimus. We've got 2 funds, a multi-strat that, as Rob mentioned, the vintage is pretty OG. We've been in the space since 2017, and then recently launched a long-short fund. And we have traded derivatives with Rob since inception, basically, too. So happy to be here, and thanks for coming out.
Hi, Andy Baer from CoinDesk. CoinDesk is the most trusted voice in crypto. It's a 10-year-old media company. It's an events company. It's also an index business, so I run product for CoinDesk indices. We have a number of products, including we're working with Coin Fund on Caesar. We're working on systematic strategies, actually, with Chris's firm. And we have the CoinDesk 20 index, which is the most liquid crypto index for which Cumberland has been a market maker. So we're all around the space. I 20 years in sell-side equity derivatives at Bankers Trust, Deutsche Bank, BNP, and 3 years at a quant hedge fund before finding my way into this fantastic asset class.
Amazing, thank you. Andrew, we'll keep it with you. I think perhaps an initial important question for the audience would be, why are derivatives important? Maybe a little bit about how they've played a role in your background in traditional markets and how you see that playing out now with a lot of the growth, not only just in the utilization of derivatives, but the product class as a whole in digital assets.
For sure. So derivatives are the primary risk management tool for many asset classes. I think equities are often the ones that are most intuitive because retail investors get to use equity derivatives, I think, fairly regularly, right? If you own a stock, you sell a call option against the stock, you receive the premium of that call option, and you get extra yield. So you're allowed to do this in a retirement account. This is something for which fewer permissions are necessary in a brokerage account. So people get this sense of optionality in a yield context. If you work at a bank or an insurance company, part of your risk management and statutory capital preservation recipe is to make sure that if equity markets go down 20% instantaneously, your firm is still standing. So you're using index derivatives, S&P 500 options daily to make sure that your risk profile in those conditions are sound. In the crypto space, and the derivatives use that I saw from outside are one of the things that drew me into the business, because a lot of that talent and experience had moved over, had ported over into crypto native funding, Delta One and options books, both over the counter and exchange wise. So a lot of the crypto derivatives are used more in a speculative sense right now than a risk management sense. But the standards and the promise of how big and broad the market's getting, and now how a lot of that is translating into onshore markets on CME and soon with ETF options, is very promising for similar use cases. So it helps complete the market, financing, risk management, and things like structured products.
Great. So risk management, which I think is a really important topic in an asset class, meaning digital assets more broadly, where risk and how to manage that risk, most people think of it as volatility, although that's just one dimension of it, can be managed, right? So it is possible to invest in this asset class and still manage the risk. Derivatives is a big part of that. So maybe, Chris, I'll pass it on to you. If you could share some similar perspective, that would be great.
Yeah, I think in digital assets, maybe a little unlike fixed income derivatives and equity derivatives, you can accomplish two expressions of two different theses with the structures. They can be risk managed, but they can also be a source of alpha. And unlike equities, the skew is to the call side, to Andy's point. And so the other side from OGs like all of us sitting here, I don't want to ever sell my Bitcoin, right? So how am I going to control the vol for our LPs when there's only 21 million of this, and trying to profit take and create a zillion tax instances, which our algos do, is one thing, but on our net long position, I don't want to get rid of that. So how do I delta, gamma, vega hedge? And it's a newer market, to which CoinDesk 20 has been probably one of the most successful index perps, I think, ever. And then our work with Cumberland, we do some pretty dynamic structures, taking advantage of premiums across different vintages. There's a kink in the November contracts right now. So you can do a combo of risk management and alpha across pretty much going out 2-3 years.
Yeah, and so a couple things that I'd maybe reframe a little bit. Sounds like we're talking about two additional aspects of derivatives that are really powerful in the market today. One's monetization. So I'm a hodler, I got a bunch of Bitcoin, what do I do with that? You can risk management, or you can monetize it without having to sell it. That's really important. It's a very common theme in how people use derivatives in traditional markets or non-digital markets. That's really important. But I think, the other thing
I like
is,
that, by the way. Let's just call traditional non-digital markets.
Non-digital,
Right?
non-digital.
That's
yes,
great.
Digital and non-digital. I agree
You want to
with
be
that.
non-digital your whole life? That's fine.
Yeah, totally. But then the other thing is, you have institutional counterparties to work with in this space. So people are doing this, and that's, to me, one of the most interesting areas of digital assets, and specifically derivatives right now, is there's actually a lot more happening than people realize. And so that's coming through OTC markets, which is generally how a lot of the big guys are playing in the derivative space. But then there's also listed markets. So there's been a lot of talk about what's going to happen with potentially listed options on IBIT, the BlackRock ETF. So Chris Perkins, I don't know if you'd want to add anything there, but I think those are two really interesting developments. Would love your perspective.
I think it's still pretty early for robust derivatives markets. If you look at non-digital finance,
Non-digital, yeah.
interest rate markets, $500 trillion asset class, only now beginning to show their head in crypto. Why? Because some derivatives markets are largely institutional derivatives markets. Those markets really haven't arisen yet and really cultivated that liquidity. But the utility is so obvious, right? Why? Because when I step back and I see what's happening right now, I see fixed income everywhere, but those markets haven't materialized. How do I see it? I see it in the form of perps. We have funding rates, right? Those are rates. I see it in the form of staking rates. Oh my gosh. And trust me when I tell you that as institutions enter this space, they're going to want to hedge those rates. And there are other folks who are going to say, wow, what an incredible opportunity to speculate on those rates. And those are defined terms in traditional markets. So I think we're at the starting line for what's going to be a very exciting and robust market. And the other issue that we've had is that we've lacked regulatory clarity. And so, yes, we've got Bitcoin and ETH. We're pretty sure those things are commodities right now. But as you go down the stack, I'm very excited to see the market understand the characterization in the United States of where these assets lie. And then you're going to see the derivatives markets pop.
I just want to underscore one point you were making. Bitcoin being a sovereignless, decentralized monetary asset, it doesn't have a yield curve yet, right? It will someday. It doesn't have a yield curve yet because it's not issued by a sovereign that also issues debt. But there are borrowing and lending markets. So there should be, even if there's not like a sovereign yield curve, there should be the equivalent of a swap curve, right? And the moment there's a swap curve and there's 2 trillion of Bitcoin, right? Or 1 trillion now, but 2 trillion or 10 trillion years from now, there will be a yield curve, and there will be interest rate swaps because there will be borrowing and lending against that, and many people will want to convert between a floating and a fixed rate. So there's no reason why those structures won't evolve. And so it's great to talk about equity options and yield enhancement and speculation, but I think that's a key point that if you go all the way from perpetual futures, which if you don't know how they work, we should get into how they work because they're fascinating, all the way to term rates and a term structure and a swap market. That's real money, right? That's the real institutional money, and that's going to happen.
It's not if, it's when. In the venture side, we're seeing a lot of really interesting projects popping up right now trying to solve it. What my question is like, what's going to be the catalyst? And maybe it's some of that regulatory de-risking that we're going to see post-election.
And I'll add to the level of sophistication that's entering the derivatives market right now is mind-boggling. I mean, just over the last 2 years, that the derivatives market's gone from a mainly retail focused driven market to very much an institutional driven market now. If you go back to 21 when I joined DRW, everyone was talking about hodling. Hodling was everyone just wanted to be long and forget about it. And over the last 3 years, we've had a number of major instances within crypto that you probably would have had to have, lived 20 years in the TradFi markets in order to see that level of ups and downs. And what that's really brought to light is the fact that you can't just hodl crypto. If you're running a large portfolio of crypto, you need to be able to hedge it. You need to be able to generate yield. You need to manage this portfolio to make sure that at the end of the day, you go home and you haven't lost, your investors' money. So it's been really refreshing to see institutional accounts enter the space, bring strategies that they've honed in equities and rates and FX, and really start bringing the level of realized vol lower and kind of bring in a little more maturity to the markets.
That makes a lot of sense. I think perhaps just legging off of some of the really well-made comments just now, what about liquidity in the option space? Where are we seeing liquidity? Where are we not seeing liquidity? Why does that matter? And I'll keep it with you.
Sure. Listen, liquidity is still a fraction in crypto as it is in equities and rates. I mean, it's still a very nascent market. Most of the liquidity within the options market in particular is still offshore on exchanges like Deribit or OKX. However, that's definitely changing, and that has been changing quite dramatically since FTX. So there's been a marked movement away from foreign exchanges into the CME. So people are much more cognizant of counterparty risk now. There's also been a big movement out of listed into bilateral trading. And that's where you get a lot more transparency. So if you're trading bilaterally with a firm like Cumberland, you'll get audited financials, you get to speak to a human being, you get to talk to risk managers and credit officers, and it feels very TradFi in that respect. And so that brings a lot of security and confidence to counterparties that they don't necessarily get from the exchanges.
Chris?
I think Rob's 100% correct. And also people need to understand there's really 3 pools of liquidity: SEXs, which are centralized exchanges; DEXs, which are decentralized exchanges; and then the OTC or secondary market on that. And there has been a rotation a little bit away from DEXs, but on DYDX, there's actually super big liquidity on those contracts. And so we're kind of feeding and pricing from all sources to create what we would call a mid to then base all the decisions off of. But whilst being somewhat nascent and young. I think there's a super deep pocket of liquidity on Bit and ETH. And unlike 2019 through really first quarter 2022, there's about another 20, 30 names that had a lot of liquidity in the options market, even weeklies, and it's pretty much disappeared. Some of that is a TradFi concentration to only Bitcoin and Ethereum, and maybe that's even regulatory. But we would certainly like to see this advancement that on Bit and ETH that's occurring happen on a lot more names, because there is deep liquidity in the top 100.
That's it. I mean, it's a good point, and a lot of what we're working on is both in the investment space and in the option space, recognizing that liquidity in anything after Bitcoin and ETH, or investor interest in anything in Bitcoin after Bitcoin and Ether, even attention span after Bitcoin and Ether for the people who are going to spend 5% of their time thinking about digital assets is limited. We think, and just mirroring what happens in equities and in commodities, right? Index derivatives solve that problem. Both Delta One liquidity instruments, futures, and options solve the risk management problem to create avenues towards breadth, diversification, correlation plays, everything from alpha generating correlation markets with index options all the way down to risk management that reaches beyond the majors. So I don't foresee that we're going to enter a world. Think about why equity options in the United States are so liquid out to many strike prices across 5,000 names, because of requirements, because of exchange requirements. Kind of wouldn't exist if there weren't those requirements intended to protect retail investors, to make sure there's a bid and offer for every strike, for every name. Crypto's not in any foreseeable future going to have that kind of requirement. Liquidity is going to exist when it needs to exist. Bitcoin and Ether, price discovery is still difficult, right? So we think index options will present a solution for risk management, for the more 5%er investor, right? And indeed for the hedge fund who wants to find new alpha opportunities.
One point that I think is important to make before we move on is, while it is nascent and it is complex, this is, without exchange requirements, what ends up happening is you get the realist price on Earth. And it's a fascinating, as a quant, it's fascinating to pull in this data, because it is the only market where humans are entirely in control, speculative or otherwise, of the price itself. And then because it's on blockchain, you get to analyze it 3 days from Sunday. So it's an absolutely fascinating thing to witness, participate in, and hopefully benefit from.
Yeah, and you mentioned IBIT, Vol, as well. I mean, that's going to be an amazing addition to crypto. So if you look at the actual underlying ETFs that brought in over 20 billion of flow into the crypto space, it's a trusted venue that institutional accounts can experiment with and get comfortable with crypto. The IBIT options will be the same thing. They'll be able to get to know the vol, how the stuff moves, get the risk managers comfortable with the product. And that then leads into more complexity, leads you down further into the tail of crypto. So we're very excited for that to come when it does come.
Let me just add something on tail exposures on derivatives. You have the traditional folks that don't have the tech to keep up, and you have the crypto folks that don't have the licenses to be competitive. And part of it is some structural issues where current regulations require intermediaries in a world where you don't need them. So I think over time we're going to see convergence. One of the other handicaps amongst the traditional folks is that, clearing is centralized risk. And if you're starting to put more and more crypto and mixing that risk with farmers and ranchers, that's an issue. And so over time, I do think the crypto natives have a leg up. It just takes time to get those licenses in place.
Makes a lot of sense. And just to recap, and a healthy portion of this conversation has been around where derivatives are, again, in digital asset markets today. So CeFi exchanges, right? CEXes, which is, looks like a normal traditional exchange. There's fiat on-off ramps. It operates with people, all the normal things that you would expect. DeFi being basically an exchange on software. So not people, digital assets in, digital assets out. But what about traditional markets? We talked a little bit about IBIT, and I think with the idea that traditional markets coming in, whether it's option markets on all the exchanges that people use for option markets, whether it's more futures products, more swaps products, right? The derivatives market's very, very, very big, right? There's a lot of pieces of that we haven't discussed yet. I'd love to get this panel's perspective on how the advent of both more products and more liquidity on traditional venues for equitized, let's just say equitized digital asset markets like IBIT, for example, Bitcoin, is going to help. I'd love to touch on that, and then I'll have some follow-up questions. But maybe, Andrew, I'll come back to you.
I mean, one thing is it's not equitizing crypto, but the idea of, I guess, converting the idea of perpetual futures into traditional exchanges is interesting. A lot of exchanges are trying to think about how they could do that. Very briefly, perpetual futures are very popular amongst offshore crypto exchanges, widely used by retail, often more than 100 times levered. And the basic idea is rather than a futures contract having an expiration date, and until then you just exchange variation margin, in a perpetuals contract, every hour or every 8 hours, you kind of true up your P&L, right? So you have an account which is going to fund your P&L fluctuations, but because of that, you're not funding anything and you don't need to have a forward. So the contract can go on as long as you hold it because you're just kind of truing up. The only kind of borrowing you're doing is for the next hour or the next 8 hours. The rates that can be implied from those futures prices are as much an expression of supply and demand as they are of funding, which is fantastic information to have. When you think about it, why should an equity index futures contract last 4 months, right? It's clunky. Why not just exchange P&L every day and have the index futures contract go on forever? So that's one innovation that I think a lot of the kinks have been ironed out of in crypto that a lot of exchanges might want to adopt for financial futures products. To the question of equitizing, I have to go back to index products because the regulatory path of waving in tokens one by one, which is how the SEC is approaching things here and how the SFC is approaching things in Hong Kong, is frustratingly slow and inagile, and I think there's a broad recognition of that. Index products which immediately grant investors diversification benefit, and also if one token goes bad in an index, it gets replaced, right? You don't lose everything and nobody has egg on their face too badly. So index products are broad market products that are both expressed in, let's say, ETF wrappers, but also in derivatives markets, are probably the ultimate tool to help the 5%ers, but also protect retail investors, and also allow the holdings of these long-term, crypto holdings to sort of refresh themselves into the latest winners. So we're hoping that there is a regulatory path to having methodology-driven index products be sort of a core crypto holding, perhaps outside of Bitcoin.
What would an example of an index product be? Like what would your wish list be? What would be number one?
I mean, we launched CoinDesk 20 about a year ago. It's traded close to $9 billion now in perpetual futures offshore. There are 2 funds launched. There's 3 structured products launched in Europe and in APAC. It has custodial support. It has already traded over-the-counter options with 2 dealers. The market's just begging for it, right? Those investors who like to get exposure to risk assets via, let's say, principal protected notes rather than ETFs, this is perfect for them, right? An index product where they're not token picking. Everybody should own a little Bitcoin, but if you want Web3, you may not want to token pick. So after Bitcoin, what's next? And so that product's been super successful. The market's been ready for it. We have broader versions that are on deck to come out next. But liquidity and standardization and broad adoption of one index so that everybody knows how the options should be priced, how the forward should be priced. Fund managers know that market makers can trade it quickly, implementation will be cheap. That's the delivery that we want to make to the market to improve the investment environment for retail investors and for high net worth family offices all the way to institutions.
Yeah, please, Chris, go ahead.
That was really good, Andy.
Thanks. It's a little pitchy, but sorry.
I have a huge wish list. There's going to be, to answer your question specifically, the options on IBIT, they'll bring new and more participants to the space, likely enhancing liquidity, but not without downside as well. Like, think about how they're going to settle in kind, right? So that makes that complexity push out a lot of participants. I think, maybe not initially, and they'll learn the hard way, but I know what maybe Chris and I would like to see, in addition to what Andy just described, is some sector taxonomy and indices or baskets based on various sectors across the digital asset space. We have to construct them internally with kind of a best efforts. But like, for example, DPIN, which is decentralized physical infrastructure, there is roughly 230 names that are, I wouldn't say investment grade, but reviewable, that command your time to underwrite them. And that's one of the newest spaces, right? And then meme coins could be their own sector basket. And I think from the initial sort of large cap baskets and indices, that would be great to see next.
I'll jump in. So I think to have true deep liquidity, you need institutions. And to have institutions are happy to take market risk. They don't want to take operational risk, and they don't want to take regulatory risk. So let's look at operational risk. That leaves you with non-deliverable products. I think you can probably have a deliverable product if it's an equity or a bond or something. But for crypto, they don't want to deal with the hassle of custody and everything. So that leaves you with non-deliverable products. On the regulatory side, again, it's going to take some time to work this out. So if I'm thinking about the next version of products, which ones can satisfy both of those? I go back to rates. Why? Because rates are massive. They're commodities. Everyone knows they're commodities. It's a $500 trillion swaps market. Eurodollar futures, it's probably the largest, one of the largest, if not the largest liquid futures market. So to me, that's the next obvious instrument and asset class that's staring us in the face.
There's also the tech derivatives too. Hash rate, block space.
For sure.
Yeah, because there's a huge arms race in digital assets that very few are paying attention to.
And particularly as rates are coming down, I think there's this massive quest for yield, right? And so when you have yield-like products, like look at the ETH staking rate right now. It's 2 times that of 10-year treasuries from a real yield perspective when you account for inflation. So I think those yield hunters are about to pop up and say, where can I get this exposure? How can I get... Go ahead. Yes. Say it. Say it. No, please.
There's also restaking, and there's protocols now like Babylon where you can actually post Bitcoin and get staking yields in a portfolio of altcoins that you select. Same with EigenLayer, which just came out. So there is the advancement. First off, the best talent on the planet is in digital assets, period. Bar none. Sorry, folks. It's not even funny, the technology and traditional finance combination. It's just pushing the envelope pretty much faster than anybody could assume. But there's all the different rates and the different willingness to pay, and some of that can be a rate on automated market making, where effectively in DeFi, you can just push to a bot and it'll swap back and forth. Uniswap they just went over $2 trillion in total liquidity in the last 4 years. It's an amazing accomplishment for a decentralized exchange. But to Chris's point, rates in almost like an on-ramp and off-ramp are extraordinarily easy to construct and monetize right now.
Yeah, and if I think about my conversations, particularly with banks at the moment, NDFs,
somebody said the B word.
Yeah, right. Those are definitely high on the list for banks. Again, for the same reason as Chris pointed out, they can't hold the underlying crypto. So a derivative product is a much easier way for them to enter the space. And again, when you think about the institutions that they're covering, that suits their risk as well. It's off balance sheet. There's no underlying deliverables. They don't have to worry about custody. And then you can incorporate all these cold indices and all this other exposure into the NDF. So it's a quickly growing space. People really want to get into.
It's a super important point, and we're desperate for banks to enter. Banks can't hold crypto because of the BIS capital reserve rules, which make it punitively expensive. And banks are broadly reticent to lend against, businesses or assets specifically. So the synthetic expression of that risk, whether it's passed through into products that they issue or just proprietary positions or kind of going back to back between hedge funds is what they're limited to right now. And there's still a lot of activity, mostly on the risk space or the option space. The rate space, as it begins to pick up, even before a real yield curve builds, is going to sort of eclipse a lot of the the small speculative stuff that we see going on. So that's, I feel like, right around the corner. It really requires senior leaders at big banks to sort of warm up to this and sponsor those ideas, because I think the reputational risk is going to become why aren't you doing this, not why are you doing this.
Yeah, and it's the U.S. banks that are struggling the most for obvious reasons. The European banks are way out in front in terms of, they're even looking at custody and, they're far advanced from the U.S. counterparties.
But the why is actually really important here, right? Why are they further ahead? And I'll give you the answer, but then I want you guys to lend some perspective to this. It's because of regulation. It's because MiCA's out there. And you can say, I like MiCA, I don't like MiCA, good parts, bad parts, the whole thing. Regulation is rarely perfect, but it does make clear what the rules are, and that is one of the underpinnings that's necessary for banks to come into the game. Having at one point managed north of $50 billion at Circle and worked with every bank that would even consider working in digital assets, I can tell you they all want to do this. There's nobody that would tell you, I don't want to operate in this greenfield space with lots of opportunity and great people and new technology. But regulation has been a headwind. So what do you guys think about regulation and how is that evolving? And if you have a view on MiCA, great, and how that might impact potentially derivatives. But in general, this is one of the hottest topics, I think, out there for the adoption and growth proliferation of digital assets.
I think Chris and I, and Rob, we'll have a very robust opinion on this. I think it's, as a business owner, it's just anti-American to do choke point 1.0, choke point 2.0, and now choke point 3.0 is going on as a hurry-up offense before the election. So it's very anti-patriotic. It has no rule of law to it, and it is a very, very opaque set of criteria that they've come up with to analyze it. And just for historical purposes, the SEC has never protected any investor on earth. And to your point about MiCA, all we are looking for is a clear-cut, defined set of rules, and then gradually the courts will rule via precedents. But as an operator and an investor, it's been unfortunate to reside here.
Yeah, it's great perspective. By the way, I think we have the entire audience's attention now, so this is probably a good topic to keep going on. But
So that was the past. I will tell you that I'm absolutely wildly bullish about the future. Probably because it couldn't get any worse. But at the end of the day, time is on our side. I have a 16-year-old. The dude loves to mess around on MetaMask. As we go through these elections, we think it's going to be better either way. We've got one guy who said he's the crypto president. And we're hearing rumblings that there may be some really exceptional people appointed if the Democratic candidate wins. So time is on our side as we get what Americans expect. And this is a bipartisan focus. We had 71 Democrats join Republicans in the last market structure bill. Elections make people do crazy things. We do expect to have stablecoin legislation as early as this year in the lame duck. Market structure will follow. And then when the sleeping giant awakes, it's going to be on. And I feel like this, coupled with some of the tailwinds we're seeing on the macro front, have our industry set up for incredible success. It's not going to be easy, but but we're on the right path.
No, absolutely. I mean, we've been talking about different products that bring institutional investors into the space. Regulation is top of mind for everyone. I think MiCA is a great example. Europe was very fragmented from a crypto regulatory framework standpoint. MiCA will be bringing, 30 countries all together into one unified block. I mean, that's something that as a business owner or someone that's really trying to grow a venture within crypto, that gives you rails that you can build upon over the course of the next few years. It gives you some stability. There are challenges, though. Crypto is moving, morphing, changing on a second-to-second basis, and it's a real struggle for even people that are within crypto to stay in front of it, let alone the regulators. So even from MiCA's standpoint, there's still issues in terms of DeFi, for example, that wasn't included within MiCA when it was first created back a few years ago. But there's something there. So we just need progress. We need thoughtful regulations that we can all build upon and grow.
So are you talking about things like if two AI agents start talking to each other, decide to launch a token, and then they do, and then they start shilling it on Twitter, that's a problem from a regulatory perspective?
Yeah, let's not get into the intersection of AI and digital assets right
Goat.
now. But, yeah. But no, it's really important. I think, this industry is not short of blow-ups and people who've not done the right things or not run their business the right way. That's true of every industry, and there's a little bit of, understandably, baby in the bathwater scenario here. I think the important takeaway for this part of the conversation is that there's people who know what they're doing, who grew up in traditional finance, who have chosen to be in digital assets, who want regulation, want to know what the rules are, and that's not an unfair request.
Yeah, I think to Chris's point, as there is a destruction, let's say, of the anti-crypto army and more bipartisanship, what would be really part of the value proposition of digital assets, which is transparency, auditability, there likely is a FINRA-style SRO that comes out of some bipartisanship. And because folks like Chris and Rob, with all of their experience, can kind of guide that properly, it'll just unleash, so much capital to this space.
Yeah, and I actually think MiCA is a great example of that. Really, what you're seeing is an imperfect design. That's okay. The rules are there. And so now people are doing a lot of really impressive things that the world, quite frankly, doesn't know about yet, but it's coming. And I think we all look forward to the advent of, as well mentioned, institutional coming into the space, being part of this, and helping to grow the industry. Sorry, please go ahead.
No, I agree. This is all happening in two stories at the same time, right? We have ETFs and futures markets and traditional markets. We also have Coinbase, Kraken, Crypto.com. This is what happens when you have an asset class that starts with retail and has to swim upstream to institutional, to regulatory. It's difficult, and it's. I think what's unclear. I love the SRO idea because then you could actually incorporate traditional institutions and crypto-native institutions and have some way for them to meet. But right now, it's either you're buying an ETF or you're buying Bitcoin on Coinbase, right? And those two remain kind of weirdly disjointed from a regulatory point of view with each other. So that's just early stuff. We're also hampered in the United States by the SEC and CFTC never having been kind of reconciled, and there's kind of two outfielders running to catch a fly ball, and it ends up landing on the field, right? Yeah, and I can't remember who was the head of the CFTC right after the financial crisis who stopped that from happening, but at any rate, this doesn't exist in Europe, doesn't exist in APAC. It just creates this extra layer of intra-agency competition that just makes things a little clunkier.
And MENA's caught up too as well. They're ahead of us now.
Yeah, they're great
as well.
Yeah, so you're talking about a truly global asset class with very different states of emerging regulation, which ultimately leads to inefficient markets, which if you're a sophisticated institution, like somebody on the stage, no better place to be.
And with that, I think we need to wrap up. But I just want to thank the panel. This has been a tremendous conversation. I really appreciate everyone being a part of it. Hopefully the audience found it at least a little bit helpful. And thank you, everyone, for your time.
Thank you.